Hello everyone, welcome back to my YouTube channel. Today, we are discussing the Vietnamese dong and its revaluation. Before we start the video, make sure to subscribe to the channel and like the video. Currency speculation has once again moved into the spotlight, with renewed online discussions suggesting that investing in the Vietnamese dong could potentially lead to substantial financial gains. These claims, often presented in an optimistic and persuasive tone, have been circulating across various digital platforms, attracting attention from both seasoned investors and individuals who are relatively new to currency markets. At the center of this narrative is the belief that the Vietnamese currency may undergo a significant revaluation, a scenario that proponents argue could dramatically increase its value, and, in turn, generate large profits for those holding it. However, financial professionals and market analysts are urging caution, emphasizing that such claims should be approached with a critical mindset. While the idea of a currency's revaluation may appear appealing on the surface, particularly in an era where rapid wealth generation stories frequently gain traction online, the underlying realities of global currency systems are far more complex. Experts warn that these narratives often oversimplify economic mechanisms and overlook the substantial risks involved. The current wave of interest in the Vietnamese dong bears a resemblance to previous speculative trends seen in other currencies, most notably the Iraqi dinar. In that case, widespread claims about an imminent revaluation led many individuals to invest heavily, expecting extraordinary returns. However, those expectations largely failed to materialize, and the situation eventually drew the attention of regulatory authorities. Reports indicated that legal action was taken against individuals and organizations that promoted misleading investment schemes, resulting in significant financial losses for many participants. In the context of the Vietnamese dong, analysts point out that similar patterns are beginning to emerge. Online discussions often highlight selective economic indicators or geopolitical developments, presenting them as evidence that a major currency shift is imminent. While these arguments can sound convincing, experts stress that they frequently lack comprehensive analysis and fail to account for the broader economic framework in which such decisions are made. One of the key factors often cited in these discussions is Vietnam's current exchange rate policy. The country has historically maintained a controlled approach to its currency, managing its value in relation to the US dollar. This strategy is commonly referred to as a peg, or a managed exchange rate system. By keeping the dong relatively weak compared to stronger global currencies, Vietnam has been able to support its export-driven economy. A weaker currency makes Vietnamese goods more competitive in international markets, which in turn helps sustain economic growth and employment. From an economic standpoint, this approach has been largely intentional and strategic. Governments often use currency policies as tools to achieve specific objectives, such as boosting exports or stabilizing domestic markets. In Vietnam's case, maintaining a competitive exchange rate has played a significant role in its development as a manufacturing and export hub. As a result, any decision to significantly alter this policy would not be taken lightly, as it could have far-reaching consequences for the country's economy. Some of the recent speculation has been linked to broader geopolitical dynamics, particularly trade relations involving major global economies. Observers have noted that political pressure, especially from influential global leaders, has in the past been directed at countries accused of keeping their currencies artificially low. The argument behind such criticism is that weaker currencies can create trade imbalances, giving exporting nations an advantage while disadvantaging others. This line of thinking has led some speculators to believe that external pressure could eventually force Vietnam to adjust its currency policy, potentially leading to a stronger dong. In theory, such a move could increase the currency's value, benefiting those who have invested in it beforehand. However, financial experts caution that this scenario is far from guaranteed and depends on a wide range of unpredictable factors, it is important to recognize that currency markets are influenced by a complex interplay of economic indicators, government policies, global trade dynamics, and investor sentiment. Predicting a major shift, such as a significant revaluation, requires not only a deep understanding of these factors, but also an acknowledgement of the inherent uncertainties involved. Simplified narratives that present such outcomes as inevitable or imminent can be misleading and potentially harmful to investors. Moreover, even if a country were to adjust its currency policy, the resulting market reaction could be highly volatile. Removing or altering a currency peg, for example, does not automatically lead to a stable increase in value. Instead, it can trigger sharp fluctuations as markets respond to the new conditions. In some cases, currencies may initially rise, but then experience rapid declines due to speculative trading or changing economic outlooks. This volatility represents a significant risk for investors, particularly those who may not have experience navigating currency markets. Unlike traditional investments such as stocks or bonds, foreign exchange trading can involve rapid price movements and high levels of uncertainty. Gains can be substantial, but losses can occur just as quickly, especially in emerging market currencies, where liquidity and stability may be more limited. Another important consideration is the gap between policy announcements and actual implementation. In the realm of international trade and economic agreements, it is not uncommon for countries to make commitments that are only partially fulfilled or delayed over time. Negotiations can be complex, and outcomes may evolve as political and economic conditions change. As a result, basing investment decisions on anticipated policy shifts can be particularly risky. Financial professionals emphasize the importance of distinguishing between informed analysis and speculative hype. While it is natural for investors to seek opportunities for growth, it is equally important to ground those decisions in reliable data and realistic expectations. Relying on unverified claims or overly optimistic projections can lead to poor financial outcomes, and in some cases, significant losses. The renewed interest in the Vietnamese dong also highlights the broader role of social media and online platforms in shaping investment trends. Information can spread rapidly, reaching large audiences within a short period of time. While this can be beneficial in terms of accessibility and awareness, it also increases the risk of misinformation. Not all sources provide accurate or balanced perspectives, and distinguishing credible analysis from speculation can be challenging. For individuals considering currency investments, experts recommend taking a measured approach. This includes conducting thorough research, consulting reputable financial sources, and understanding the specific risks associated with foreign exchange markets. Diversification is another key principle, as concentrating investments in a single asset or currency can amplify potential losses. In addition, regulatory bodies in various jurisdictions continue to monitor and address misleading investment practices. The experience with previous currency speculation cases has underscored the need for vigilance, both on the part of authorities and individual investors. Ensuring transparency and accountability in financial promotions remains an ongoing priority. Ultimately, the narrative surrounding the Vietnamese dong serves as a reminder of the complexities inherent in global finance. While the prospect of a currency revaluation may capture attention and spark interest, it is essential to approach such claims with a balanced perspective. Economic policies are shaped by a wide range of factors, and outcomes are rarely as straightforward as they may appear in online discussions. As the situation continues to evolve, market participants will be watching closely for any indications of policy changes or shifts in economic strategy. However, until concrete developments occur, much of the current discussion remains speculative. Investors are encouraged to remain cautious, prioritize informed decision-making, and avoid being swayed by narratives that promise guaranteed or extraordinary returns without adequately addressing the associated risks. In the broader context of global markets, this episode also reflects a recurring theme: the tension between opportunity and risk. Financial markets offer the potential for growth, but they also require careful navigation and a clear understanding of underlying dynamics. By maintaining a disciplined approach and seeking credible information, investors can better position themselves to make sound decisions in an increasingly complex and interconnected economic landscape.